How should you invest in bonds right now with interest rates going crazy, the potential for them to skyrocket with inflation skyrocketing? How do you invest in bonds? I've got an idea for you coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Several months ago, got a comment from a fan on the YouTube channel that said, momentum strategy equals bonds, question mark. And I'm sort of old and crotchety, but I'm pretty sure they were saying, could you use a momentum strategy with bonds? Or maybe I mentioned it in the video, and why would you? Why would you want to? And wow, I've had this on the list for us to talk about for a long time. And then here we've seen over the past 2 weeks this rising concern of inflation and what that's done with bonds. And my goodness, it's the perfect time to talk about whether you should have a dynamic strategy with your bond investments. And so let me set the table a little bit and tell you why, number one, like sort of what's the story problem? And the story problem right now is bond investments or bond mutual funds, they tend to perform the opposite of interest rates, okay? It's like a teeter-totter. So if interest rates are high and they're going low, your bond investments will go low to high. So if interest rates are going down, your bond investments are going up. That's wonderful, okay? Because if interest rates were high and they're going lower and you held some of those high interest rates, now that they're lower, those high interest rate bonds are worth more because they pay high interest. And whether you know it or not, whether you're a financial geek like me or not, that's what's happened since the 80s. And so I can't even say like, yeah, it's been happening for the past couple of years, interest rates have been going down. No, for decades. So if you've ever owned a bond mutual fund up to this point, you have benefited from that relationship. There's no doubt interest rates have gone from the last time we were at hyperinflation, 70s and early 80s, and they have gone down to, you would argue, the floor. They can't go any lower unless they go negative. So interest rates have come down, your bond investments have gone up. And now there's this question, there's this concern. We're printing trillions and trillions and gazillions of dollars, and the Federal Reserve has promised to keep their short-term interest rate really, really low. So what happens? That is, as the economy heats up and as more money is pumped into the system, but there's supply issues and there's more demand than there's even supply to match it, that's the definition of inflation. There's more money out there chasing over too few of goods. That's inflation. Now, technology is deflationary. So we've got conflicting stories here. Like we've got, crossing winds, which is just makes this an unusually risky time as an investor, because technology is a force that is just pushing everything lower and making it more scalable. But we've got trillions of dollars printed into the economy, and as we're seeing inflation, so housing prices at all-time high, copper prices near all-time high, oil has spiked again, lots of commodities have gone up in value. Timber, right, has gone up in value. If you're trying to build a house, you can barely even find lumber right now. So all sorts of things have gone up in value, and therefore interest rates, not the Federal Reserve interest rate that the Fed funds rate that they control, it's the interest rates that float in the open market are starting to go up. Okay, and as interest rates go up, that same inverse relationship with bond values happens. So if interest rates start rising, bond values start falling. Okay, that's a precarious situation, especially for those of you that are wanting to take less risk, or maybe at a season in life, approaching retirement or in retirement, where you should take less risk. Okay, how do you do so within bonds when that potential relationship could happen, where interest rates could be set to rise and therefore your bond investments could underperform? Well, this is where I would tell you, make sure you have a diversified approach with your bonds, and yes, that you have a momentum strategy with your bonds. Maybe not all of them, but certainly for some of them. Because right now, as the Fed has said, hey, we're going to keep interest rates low, bond investments should do okay. But if things get overheated and if we start seeing hyperinflation, which are the concerns right now, bond investments could all of a sudden become very, very risky. So therefore, holding them if everything stays normal, but if things get riskier than you would want, having a mechanism to adapt to changing financial conditions. That's dynamic. So how's dynamic work for a bond strategy? I've told you about how it works in a stock strategy. A momentum model surveys the landscape of investment choices within stocks and different sectors and all of that all across the globe. Which areas have momentum? Let's use those. Let's put those in the portfolio. And then when momentum changes, that momentum strategy will pivot those areas that are starting to underperform back onto the shelf and invest in the areas that are gaining momentum. Same thing happens with bonds. So how this works is you've got a system, and this is what we have built here at Korhorn Financial Group, but this is what I mean by momentum investing, is you've got a system that is able to survey the entire landscape of investment tools, okay? So within here, you've got every possible investment choice that you'd want to have under the sun. And then you're monitoring this on an ongoing daily basis, because if you're not, then momentum can change too quickly and you might miss it. You might be too late, but you're monitoring this on an ongoing basis. And the 6 areas that have the most momentum are plugged into the portfolio, okay? And then as momentum shifts, as momentum changes, if this area starts underperforming, it goes back on the shelf. And if this area starts outperforming, gaining momentum, it goes into the game, right? And then because it's a momentum strategy, if everything's losing momentum and nothing's gaining momentum, obviously this can pivot onto the bench and you can just hold cash. So we understand this from a stock standpoint, and that's, sometimes it's called sector rotation or just looking at, US or international, which one has more momentum. But you're going to want to apply this within your stock investments all the way down to biotech, to gold, to small value, to emerging markets, and all sorts of those pieces, right? You can do the same with bonds. I mean, you can have a chunk in here for emerging market bonds. You could have a chunk in here for high yield bonds. You could have a chunk in here for convertible securities. You could have a chunk in here for munis. You could have a chunk in here for Fannie Mae and Ginnie Mae and all that, right? And so all of those pieces can be analyzed on an ongoing basis to say, where is their momentum? International bonds, government bonds, right? So there's all, in fact, the bond market, the fixed income market, last I saw was something like 4 times the size of the stock market. So there's all sorts of those pieces, and you want to use a momentum strategy that's looking and saying, of all of these pieces, which are the areas that have the most momentum? And when they're in this model, you're earning, obviously, you're having the price action and gaining any capital appreciation that would happen, but you're also earning the interest percentage while you're holding those bond funds. And if high yield's in favor right now, but all of a sudden risk errors, starts to present itself, high risk, high yield can go onto the bench, and we can bring, Fannie Mae or Ginnie Mae investments in, and hold those instead, which would have a different percentage, but it would protect the downside risk that bonds at this time may offer and might have a higher potential for downside risk than they've had in the past. So that's the long answer to, can you have a momentum strategy with bonds like you would with stocks? The answer is yes. And not only can you, I would strongly argue that you should, because right now, with the relationship between interest rates and bond investments, bonds might be riskier today than they've been at any point in your life. Make sure you're diversified, and I would encourage you, make sure that diversification includes some of that being in a momentum strategy. If you need some help with that, contact my team. You can find us online, Korhorn.com, that's Korhorn with a K, or wisemoneyshow.com, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.